Good morning, everyone, and welcome to the Daily Hunt for Multibaggers. It's Wednesday, January 28th, 2026, and we're breaking down the market intelligence we gathered yesterday, Tuesday, January 27th.
Well, Ethan, it was certainly an active day on the social feeds. We saw a pretty significant number of stocks flagged, with some truly massive spikes in discussion volume, particularly for tickers like Reddit and United Health.
Absolutely, Brooke. While there's a lot of chatter, the overall market sentiment, it feels a bit mixed. We've got some strong growth stories still capturing attention, but also, of course, plenty of caution, which is what we're here to unpack for you.
Let's kick things off with a familiar name, MasterCard, ticker MA.
For MasterCard, the fundamentals are looking incredibly solid. We're seeing strong profitability with a net profit margin over 45% and a very healthy 16.7% revenue growth. That's serious business for a company of its size. Analysts are still weighing whether MA stock is a smart bet ahead of earnings, suggesting continued institutional interest. It really shows potential as a long-term play.
Ethan, I agree, those margins are impressive, truly excellent profitability. But the KPIs also show a price-to-earnings ratio of 33.23. That's a premium, suggesting a lot of future growth is already priced in. And with a very high debt-to-equity ratio of almost 240%, that's a lot of leverage. Plus, with their Q4 earnings tomorrow and chatter about a potential Trump credit card cap adding regulatory risk, I'm just seeing too many uncertainties to be outright bullish.
Fair points on the short-term volatility, but the operational efficiency and revenue growth really paint a picture of a company capable of navigating headwinds.
Perhaps, but prudence is key. So for MasterCard, MA, we're classifying it as a cautious buy.
Next up, Apple, ticker AAPL, historically a fan favorite. Apple's financial engine, it's still a powerhouse, Brooke. We're looking at a strong 26.91% net profit margin. That's fantastic, and an impressive return on equity over 171%. We even saw a slight net insider buying over the last 6 months, which is usually a good sign of long-term confidence from those closest to the company.
Ethan, it's Apple. I get the allure. But the PE ratio is over 34, and the price to book is an astonishing 51.7. We're talking about a stock that's already priced for perfection, and it's near its 52-week high. Plus, Jefferies recently flagged App Store and Google ad risks, and Alethea maintains a sell rating. This just screams overvalued for a new entry. It was rated buy just yesterday, but these valuation metrics, they really weigh on the decision.
Yeah, the valuation is certainly elevated, but their ecosystem and brand loyalty are almost unparalleled.
Even so, with those risks and stretched metrics, Apple, AAPL, is a stay away.
All right, let's move on to Tesla, TSLA. There's always a lot of chatter around Elon's companies. The community's still buzzing about Tesla's long-term vision, full self-driving, Optimus, robotaxi. Elon has a way of defying expectations, and these technologies, if they truly deliver, could absolutely be game changers for future growth, regardless of short-term hiccups.
Ethan, defying expectations is one thing, but a price-to-earnings ratio of almost 293? Come on, that's an extreme premium. Users are right to be concerned. We're seeing projected sales declines and market share loss in key regions like Europe and China, plus their net profit margin is barely over 5%. The current numbers just don't support that valuation, and the user sentiment is heavily bearish. We've largely rated TSLA a stay away or speculative gamble for a while, and these numbers reinforce it.
It's definitely a high conviction play for many.
Perhaps, but for us, Tesla, TSLA, remains a stay away.
How about Advanced Micro Devices, AMD, another big tech name with lots of hype? The buzz around AMD is quite something, Brooke. Users are talking about a $300 target, and the news confirms insatiable server CPU demand. Analysts are even eyeing a $1 trillion valuation by 2026. That's serious growth potential, especially with AI fueling everything. They've even seen some buy ratings from us recently.
Ethan, I hear the excitement, but that PE is over 131. We're talking about huge expectations already baked in. And with a debt-to-equity ratio over 6, plus a beta of almost 2, this is a very volatile, very leveraged play. The return on equity is modest at 5.32% for a stock trading at such a premium. The risk-reward just isn't there for me when the current KPIs don't quite justify that extreme valuation. The future demand might improve KPIs, but it's not reflected yet.
But the demand for their chips is real,
It is, but the price reflects a perfect future. AMD, in my book, is a stay away. Moving on to Meta Platforms, Meta, we had a couple of posts here.
Meta's core business is still a money machine, Brooke. We're seeing revenue growth over 26% and an impressive return on equity north of 32%. They're even testing paid features, which could open new income streams. The underlying financials are robust, and we've rated them a buy many times, even as recently as yesterday.
Ethan, the numbers are good, but the future numbers are what concern me. Users are worried about their massive AI capital expenditures with uncertain return on investment, fearing they might drag earnings. And let's not forget the intensifying regulatory risks, like those age-gating concerns and content moderation issues. The PE is almost 30, and there's a lot of skepticism around their Q4 earnings report. Too many unquantified risks for me, even with strong historical performance.
It feels like a pivotal moment for them.
It does, and for now, Meta is a stay away.
Microsoft MSFT is next up, always a solid performer. Microsoft is just consistently delivering, Brooke. We're seeing nearly 18.5% revenue growth, a net profit margin of almost 36%, and over 8% net insider buying. That's serious confidence from within the company. Azure AI is a huge driver too, and has tremendous growth potential. We've rated MSFT a buy many times in the past, including just last month.
Ethan, I agree on the fundamental strength. They are exceptionally efficient, but that PE of 34 is quite rich. Stifel just cut their price target over margin pressure concerns, and there's chatter about a general AI spending moderation. While it's a fantastic company, at this valuation, it's more of a monitor situation for me, waiting for a better entry if these margin concerns prove valid.
So you're not seeing immediate upside at this price point?
Not enough for a strong buy, no. Microsoft MSFT is a cautious buy. NVIDIA, ticker NVDA, is another one generating a lot of buzz.
NVIDIA is truly on fire, Brooke. Over 62% revenue growth and an astounding 53% net profit margin. They just got approval for H200 chips in China, and they're investing heavily in AI infrastructure. The growth story is absolutely phenomenal, and it was a buy for us as recently as yesterday.
Ethan, I agree the past performance is stellar, but we have a PE of almost 47, a debt-to-equity ratio of 9, and significant insider selling over the last 6 months. And the biggest red flag? Your major customers, Meta and Microsoft, are developing their own AI chips. That's a direct threat to their long-term dominance and pricing power. It's too hot to handle right now.
That competitive landscape is certainly evolving.
Indeed. NVIDIA, NVDA is a stay away from me.
All right, let's talk about Amazon, AMZN. What's the latest from the e-commerce giant? Amazon just keeps innovating and expanding. We're seeing over 13% revenue growth, a strong 24% return on equity, and those insiders are buying up shares, over 1.6 million net shares purchased. Plus, their aggressive push into groceries with over 100 new Whole Foods stores. That's a serious long-term growth play. We've been pretty bullish on AMZN recently.
Ethan, it's Amazon, yes, but a PE of 34 is definitely on the higher side. It's also trading near its 52-week high, meaning a lot of that good news is already baked into the price. While the fundamentals are strong and those insider buys are positive, for a new entry, it feels a bit stretched, you know?
I see the valuation point, but the consistent growth and strategic moves are very compelling for long-term investors.
For Amazon, AMZN will go with a buy. Next up, Next Energy, NXXT. This one's had a few posts.
NXXT has truly impressive operational momentum, Brooke. We're seeing sustained triple-digit revenue growth, over 227% in fact, moving into long-term power purchase agreements and innovating in microgrids and AI platforms. Plus, we're seeing net insider buying. Users are even calling it a loading zone for a quick flip. There's real excitement there for future growth.
Ethan, I appreciate the optimism, but the KPIs are screaming distress. An 86% negative net profit margin, negative EPS, and a negative price-to-book ratio, meaning liabilities exceed assets. This stock is trading at its 52-week low for a reason. Revenue growth means nothing if you're burning through cash and your balance sheet is underwater. This is a very clear stay away for any prudent investor. We've consistently rated NXXT as a stay away for a reason.
So despite the high growth numbers, the fundamentals are too risky.
Absolutely. NXXT is a stay away.
Moving on to Taco, Berto Acquisition Corp. Well, you know, for Taco, the user posts aren't even about the company, which means there's no real sentiment to pick up on there. But looking at the numbers, well, Brooke, this one's a tough sell.
Ethan, tough sell is an understatement. A net profit margin of 0, operating margin of 0, no free cash flow data. This company isn't generating any profit, and the industry news isn't helping with reports of other taco places closing. This is a fundamental stay away for me, no question. We've rated them stay away before.
Yeah, those numbers are pretty stark.
Exactly. Berta Acquisition Corp. Taco is a stay away. Let's turn our attention to Redwire, RWW. What's happening there?
Redwire just got selected for a massive $151 billion defense IDIQ. That's a huge vote of confidence and incredible potential for future contracts in space and defense. The stock popped 28% on the news, showing real investor excitement for their technology. This could be a massive inflection point.
Ethan, an IDIQ is an opportunity to bid, not guaranteed revenue. The financial health is just abysmal, over 70% negative net profit margin, and their debt to equity is over 22. And the biggest warning sign? Insiders are net selling almost twice their total holdings in the last 6 months. That screams pump and dump to me, and users are expressing deep distrust in management. Too much risk, too little fundamental support for Redwire, RWW.
Wow, that insider selling is quite a data point.
It certainly is. Redwire, RWW, is a stay away.
All right, let's dive into United Health Group, UNH. This one has seen a massive surge in discussion. United Health just beat Q4, Brooke, and with the stock plunging like it did, we're looking at a PE of under 15 and a solid 3.13% dividend yield. Users are definitely talking buy the dip, and with net insider buying over the last 6 months, that tells me the smart money sees long-term value despite the regulatory noise. We've had some buy ratings in the past, so the potential's there.
Ethan, I agree the PE is tempting, but the price drop was brutal. Users are calling it a falling knife because of the serious regulatory headwinds from those proposed Medicare Advantage rates. A net profit margin of just 4% leaves them very vulnerable to any cuts. It's a high-stakes gamble on political reversal, and I'd be cautious given the immediate risks. But the underlying business is strong, and the dividend provides some cushion. It does, but it's a big political gamble right now. United Health Group, UNH, is a cautious buy. Finally, a quick note on Reddit, ticker RDDT. Well, Brooke, it seems Reddit Inc. definitely caught a lot of attention, with a huge spike in user discussions. But our AI insights hit a snag on this one, so no deep dive today, but certainly one to keep an eye on given the sudden activity. Indeed, Ethan. High social volume without clear fundamental analysis means extreme caution. A good reminder to always seek full data before making any market moves.
All right, to wrap things up, let's go over our compiled list of today's candidates. Investigate as buy, Amazon.com Incorporated, AMZN. Investigate as cautious buy, MasterCard Incorporated, MACN, Microsoft Incorporated, MSCN, United Health Group Incorporated, Common Stock Day. Investigate as speculative gamble, Next Energy, NXXT. This podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice. Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses incurred. The market is a wild place, and knowledge is your best asset. All right, that's all for today's Daily Hunt for Multibaggers. Thanks for tuning in, and we'll catch you next time.